Hey there, and welcome. Today, we're going to pull back the curtain on the two invisible forces that basically decide the price of everything you buy, demand and supply. And by the time we're done here, you're going to understand the hidden logic behind why your coffee or your gas costs exactly what it does. I mean, it's a question we bump into literally every day, right? You see a price tag, but what's the real story behind that number? It's not just random. It's actually the result of this constant, dynamic dance between two really powerful groups, buyers and sellers. So, here's how we're going to break it all down. First, we'll meet the key players in any market. Then, we're going to dive deep into the buyer's side. That's demand, before we flip things over to the seller's side, supply. After that, we'll see the magic that happens when those two forces finally meet, and we'll wrap up by looking at how real-world events can shake everything up. All right, first up, let's set the stage. Every single market, doesn't matter if it's for soybeans or for software, is driven by the actions of two main groups. So, on one side of this whole equation, we've got households. Now, that's just the economics term for, well, all of us. We're the consumers. We're the ones who demand goods and services. But here's the interesting twist. We also supply things the economy needs, like our work. And then, on the other side, you've got the firms. These are the producers, the companies that take all the resources, like our labor, raw materials, you name it, and turn them into the products and services we all buy. And these two groups aren't separate. They're locked in this constant circular flow. We, the households, buy things, which sends our money to firms. Then, firms take that money and use it to pay us for our work. It's the simple loop that literally powers the entire economy. Okay, so let's zoom in on the buyer's side of things. This is all about how we behave as consumers, or what economists call demand. This all kicks off with a super simple rule that, honestly, you already know from your own shopping trips: the law of demand. It's simple. When the price of something goes up, we usually buy less of it, and when it goes on sale, we buy more. It's this basic inverse relationship. Let's make this real. Meet Alex. This table shows how much gas he's willing to buy each week. At a painful $8 a gallon, he's buying zero. He'll find another way. But if that price drops all the way down to $1, he's filling up with 20 gallons. Now, what happens if you plot those numbers on a graph? You get this, the famous downward sloping demand curve. The shape of this line is the perfect picture of the law of demand. As the price goes down on that vertical line, the amount people want to buy goes up on the horizontal one. Okay, now this is probably the most important thing to get right in this section. There's a huge difference between a change in quantity demanded and a change in demand. A price change just causes you to move along the curve you're already on. But when something else changes, like you get a huge raise, the entire curve shifts. That means you want more at every price level. So what kind of things can shift that whole curve? Well, lots of stuff. A change in your income, for sure. The price of other things, like if the price of beef goes up, the demand for chicken might shift. Even just a change in trends or what you think might happen to prices in the future. All right, we've got a handle on the buyers. Now let's flip the coin and look at the world from the producer's point of view. This is supply. And hey, just like demand, supply has its own simple core rule, the law of supply. But this one's the other way around. It's a positive relationship. The higher the market price for something, the more of it producers are willing to make and sell. I mean, that just makes sense, right? Higher prices mean more potential profit, so you're going to make more. Let's meet our producer. This is Clarence. He's a farmer. This schedule shows how many soybeans he's willing to sell. You can see as the price he can get per bushel goes up, he's ready to supply way more to the market, ramping up from 10,000 bushels all the way to 45,000. And no surprise, when we graph Clarence's numbers, we get the mirror image of the demand curve. The supply curve slopes upward. It's a perfect visual of the incentive for producers. Higher prices make it worthwhile to produce and sell more stuff. And here we go again. This is super important. That same movement versus shift idea applies here too. A change in the product's price causes a movement along the existing supply curve. But if something else changes, like the cost of fertilizer goes down, or a new technology makes farming easier, the entire supply curve shifts. Okay, this is where it all comes together. We've got these two opposing forces, right? Buyers who want low prices and sellers who want high prices. So now, for the main event, let's bring them together and see how a price actually gets decided. So here's the big question. In the real world, prices aren't always perfect right off the bat. So what happens if the price is a little too high, or maybe way too low? Well, the market has this really cool, almost automatic self-correcting mechanism. You end up in one of two situations. Think about it. If the price is way too high, stuff just sits on the shelves, right? Sellers have made more than people want to buy. That's a surplus, and it creates pressure to lower the price. On the flip side, if the price is a total bargain, everyone rushes to buy, and the shelves empty out. That's a shortage, and it puts pressure on the price to rise. So you've got these two forces constantly pushing and pulling, and they always push the price toward this one perfect spot: market equilibrium. It's that sweet spot where the amount sellers want to sell is exactly the same as the amount buyers want to buy. At that point, there are no shortages, no surpluses. The price is stable. Okay, so this isn't just some abstract theory in a textbook. It's an incredibly powerful tool for understanding why things happen in the real world. So let's put it into action with a quick example. Okay, picture this. The coffee market is just humming along. The price is stable, everything's in equilibrium. Then, bam, a sudden, unexpected frost hits Brazil, a huge coffee producer, and wipes out a chunk of the crop. That's a major shock to the system. Suddenly, there's just less coffee available at any price. That means the entire supply curve literally shifts inward to the left. And the result? The old price doesn't work anymore. The market has to find a new, higher equilibrium price for coffee. And that right there is why your morning latte might suddenly get more expensive. So from now on, when you see the price of eggs go up or gas prices drop or plane tickets get crazy expensive, you've got the mental toolkit to figure out the story behind it. Was it a shift in demand, or was it a shock to supply? The answer is right there, waiting to be explained by this elegant dance between these two incredibly powerful forces.